Bonds are lower, yields are higher, equities are a little bit softer this morning. Good morning to you all. Equity futures down about 1/3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue, pricing in a growth slowdown.
This is the markets readjusting the inversion of the yield curve.
This melt up in yields.
It's a pretty strong signal that we are facing some kind of significant slowdown.
When the curve gets flat or inverted,
it's telling you that the economy is strong today, but it may not be in the future.
I am very impressed and quite honestly surprised about how resilient equities have been.
The equity market's balancing. Yes, there's some greater risk of recession.
It's telling us one other thing.
There's also a possibility that things continue on for another 12, 18, 24 months.
It's too early to sound an alarm bell on a recession.
What the yield curve is discounting is higher odds of a growth slowdown next year.
Within a year's time, you're going to see that the impact of the flatter curve on the broader economy.
Joining us now is BlackRock's Kate Moore, PGIM's Greg Peters and Morgan Stanley's Dan Skelly. Kate, to begin with you, to what degree do you think we are pricing in a growth slowdown in the more economic sensitive parts of this equity market?
Yeah, so John, listening to those comments, and of course from two of my colleagues, Jeff and Russ, I tend to agree that the equity market has been probably a little bit more resilient than many people would have expected, particularly given the rate adjustment and given this sort of myriad of challenges we're facing, whether it's inflation or geopolitics, or this rate adjustment that we'll have through the balance of the year. That said, I think the real show me moment is going to be as companies start reporting first quarter. And I say this because not just what they did in the first quarter, but as management teams really discuss with the market their expectations around margins and cost control, how they're adjusting their supply chains, how they're dealing with higher energy input costs, I think is really going to set the tone for the direction of the market over the course of the next 6 months.
What are you expecting, Kate?
I'm expecting actually that you're going to see a massive bifurcation within the market. You're going to have these companies that have controlled their costs, that are not facing major labor challenges, perform fairly well, but the bar is pretty high. It's not just what consensus earnings are. I think we need to not just beat those earnings, but again, have reaffirmed guidance from management teams and strong conviction from those leaders that they're going to be able to weather all of these challenges I was just outlining.
Dan Skelly, growth is a big theme for you and the team at Morgan Stanley. Keith Lerner of Truist picking up on some of the weakness we're seeing already in the transports, not just there, in the home builders, in the financials over the past few days, semiconductors, the yield curve inverting too. Dan, are you expecting to see more of this in the months to come?
Good morning, John. We are, and we would say, look, certainly as it relates to the curve signal and some of these other subsectors weakening, as you mentioned, financials, transports. Look, we are on alert. We are not yet sounding the total alarm just yet. And the history is, look, post a yield curve inversion, markets actually tend to do fine for the next 12 to 18 months. But it's all about that rotation intra-market, right? It's all about going up in quality, favoring some of the more defensive sectors, and to Kate's point, certainly favoring pricing power as well. I'll add just one last thing as it relates to the global equity perspective. Over the last 6 or 8 weeks, everyone's been talking about how resilient the U.S. equity market has been. But consider this. We've seen more lockdowns in China with Shanghai. We've seen more repercussions and ramifications likely in terms of Russia, Ukraine on Europe, and a potential slowdown there. So the U.S. equity market really did get a bid because it was probably the best relative bet globally.
Greg Peters, your thoughts on all of this, the prospect of a harder landing later this year?
Yeah, so I think the timing is really tricky, Jonathan, but the outcome is pretty clear in my mind, which is the economy will absolutely slow. The number of rate hikes being priced in and what the Fed is telling you, and given the strength of the labor market, all point to they really have to hit the brakes hard here in trying to quell this inflation story. So to me, it's just a matter of time, and it's inevitable in my mind.
Greg, hit the brakes hard. What does that mean 50 basis point hikes through 4 meetings like Citi. What are you thinking about? Go hard on QT?
Well, all the above, right? I mean, you think about, the March meeting and then the subsequent meetings. I mean, the rhetoric has just changed. So I think 50 is definitely on the table. I think another 50 is also on the table. But they are going to be data dependent. And I think the strength of the payroll numbers last week and the revisions give them ample cover to be much more aggressive. And as far as QT is concerned, I think the markets are dismissing that as a risk or even part of the tightening phase. So to me, a policy mistake, as I've been saying for quite some time, is inevitable.
Greg, which part of the market is dismissing that? And if you expect a so-called policy mistake, how are you expressing that market-wise as you allocate capital right now?
Yeah, so I would say the risk markets are largely dismissing. The shape of the curve, I think, directionally is telling you the story that, the Fed is, slowing down growth in the back end. But I think there's so much momentum in the risk markets that it's really tossing aside kind of these risks. And, Jonathan, maybe it's too early, but at some point you're dancing between the raindrops and it's going to be really difficult to get out.
As you indicate, the labour market data has been so strong, that's going to set them up for a big move for the next meeting in early May. Chairman Powell told us to look towards the minutes of the last meeting to get some detail on balance sheet reduction. So tomorrow we'll do just that. Let's get to Mike McKee for a little bit more. Good morning to you, Mike.
Good morning to you, John. I'm trying to figure out a way to top Greg's dancing among the raindrops metaphor there. But you listen to Greg's view, and you can see why Jamie Dimon says he pities the Fed, because the Wall Street view is they are behind the curve and that they are going to break something by raising rates too soon. But at the same time, you've still got COVID, you've still got the war in Ukraine, and you have the Eurodollar market pricing in Fed rate cuts in a year or two ahead. So what do? If there's any pushback, it may come today from Esther George, who is a voting member of the Open Market Committee this year. We'll be talking to her at the top of the next hour and get her view on the idea of whether you do 50 in one meeting or two meetings or three, or whether you take a more cautious stance. At the same time, we're also going to be watching this week for Lael Brainerd. She's the only member of the board who hasn't spoken since the last meeting, and we don't know where she comes down on this. It will be very interesting. Sometimes she takes some positions that seem slightly opposed to where the chair is. And then, of course, finally, tomorrow we get the Fed minutes, and the Fed minutes are going to be crucial to this whole idea of QT. Do they have any clues to what kind of regime they're going to use to shrink the balance sheet? Is it going to be the same as last time with caps, maybe $100 billion instead of the $60 billion they used last time? And do they have any plans to sell anything along the way? So an interesting week for members of the market because they're going to get some clues to what their market is going to look like over the next couple of months.
An interesting day for you as well, Mike McKee, catching up with Esther George of the Kansas City Fed. Looking forward to that a little bit later. Mike McKee with the Kansas City Fed President, Esther George, 10 a.m. Eastern Time in about 43 minutes. Mike, it will be fantastic to watch you with a Fed official once more, especially ahead of these Fed minutes just 24 hours away. There is a more constructive view on the outlook for this market, and it comes from JP Morgan's Marko Kolanovic. He writes the following: the risk reward in equities is not as poor as it's currently fashionable to believe. He goes on to say the Fed repricing might be closer to the end and headline inflation will mechanically peak soon. The start of Fed tightening should not be seen as a negative for stocks. Now, Dan Skelly, you know what's happened recently. Morgan Stanley comes out with a less constructive view. A few days later, Marko Kolanovic and JP Morgan come out with a more constructive view. Take those 2 points that come from Marko and his team, Dan, and respond to them if you can. The Fed repricing might be closer to the end, 1, and headline inflation will mechanically peak soon, 2, and all of this as a reason to stay long equities. Your thoughts?
Sure. And look, what I would say is there are certain factors, hopefully the normalization of COVID with some labor supply coming back into the market, that will depress some of those inflationary pressures near term. But let's face it, you got to offset that with some of the issues we've seen the last 6 weeks with this horrible conflict and tragedy in Ukraine. Russia is one of the biggest exporters of fertilizer in the world. And so we haven't even seen some of the food inflation pressures start to show up globally there. And we think that'll be more of an issue in the second half. So, there are all these cross currents and offsetting factors to consider. It's a very fast moving market at the moment, obviously. When you think about it, being long equities broadly, in our opinion, is not the way to go. You want to be more selective. You want to be more active. And we would also take issue with the fact that the Fed might be closer to the end. We think the Fed is really just beginning to start its tightening regime. So again, that augurs for being more quality focused, a bit more defensively biased at the moment. Look, we're at 4,600 or so on the S&P. We think that's the top of the range, given this interest rate move.
We'll keep building on this. Dan Skelly, Greg Peters, Kate Moore. Great lineup going into the opening bell. One stock we're looking at this morning, Twitter in the pre-market up more than 8%. Jack Dorsey weighing in. I'm really happy Elon is joining the Twitter board. He cares deeply about our world and Twitter's role in it. He goes on to say, Parag and Elon both lead with their hearts and they will be an incredible team. One of the many movers we're watching ahead of the opening bell. Let's get to Abby for more. Hey, Abby.
Hey, John. Well, yeah, this is really pretty impressive, this move that we're seeing in Twitter. Another big up day. Right now, Twitter in the pre-market poised to go above the 200-day moving average. That's a fancy way of saying the long-term buyers are impressed here. And that's important because up until yesterday, this stock over the last year had been down more than 30%. Now it's down less than 20%, of course, on the not so surprising news that Elon Musk is now joining the board. So his 9.2% stake, not so passive as expected. And of course, he will not own more than 14.9%. But again, the stock is now technically stronger. So it's going to be interesting to see whether or not his board appointment and his stake brings other big investors to the company and on to becoming investors. Tesla, after yesterday's big 5.6% move up, it is now down ever so slightly. And of course, that move was on record deliveries. But it seems that everybody's very happy about this Musk factor for Twitter, John.
Never made sense calling this a passive stake, did it? All of yesterday, Abby.
Agreed. It really didn't, because he's clearly probably one of the least passive people out there, really a visionary and motivates people, inspires people, and seems to be doing the same thing for Twitter. It's very interesting, actually, in fact, that Michael, one of the biggest bears on Tesla, Michael Burry, known for The Big Short, he's saying he's very excited for Elon Musk to be on Twitter and they could even save America. Big words there, his opinion, but yes, people very excited for that.
Abby, thank you. About 20 minutes away from the opening bell, we'll catch up with Ed Ludlow on the West Coast with a little bit more on this story. The stock up by almost 9% in early trading. Coming up on the programme, the EU hitting Russia with fresh sanctions.
This guy is brutal, and what's happening in Bucha is outrageous. I'm seeking more sanctions, yes. I'll have time to announce that to you.
That conversation up next.
You may remember I got criticized for calling Putin a war criminal. Well, the truth of the matter is so what happened to Bucha. This warrants him. He is a war criminal. I'm seeking more sanctions, yes. I'll have time to announce that to you.
The President of the United States there, the EU following up with more sanctions. The EU Commission President Ursula von der Leyen saying the following this morning. Today we are proposing a fifth package of sanctions. She goes on to say an import ban on coal from Russia worth €4 billion per year, cutting another important revenue source for Russia. She adds to that a full transaction ban on 4 key Russian banks, among them VTB, the second large just Russian bank. This news coming in just moments ago. Specific new import bans worth €5.5 billion, targeted measures such as a ban on participation of Russian companies in public procurement in EU, and exclusion of all financial support, EU or national, to Russian public bodies. And finally, this tweet storm, if we can call it that, a thread out on Twitter, ends with this. We are also proposing further listings of individuals. We are also working on additional sanctions, including on oil imports, and reflecting on some of the ideas of the member states, like taxes or specific payment channels, such as an escrow account. A lot to get through here, so let's start the team coverage with Maria Tadeo in Brussels and Anne-Marie in DC. Maria, your thoughts on what we've learned from European leadership in the last 20 minutes?
Well, let's just run through the numbers. And honestly, the first takeaway that I would have from this, by the way, is that they finally broke into the energy. Remember, this had been a question mark, whether or not they would dare to go into energy. Now we see that they do it for coal. Now, overall, if you add up all the numbers and everything that has been announced now, we see that there will be an import ban of about 10 billion euros worth of imports from Russia and another 10 billion euros of exports going to Russia. The key takeaway, of course, is coal. From what I understand, buyers will be given 3 months to wind down coal contracts signed with Russia, and after that they have to exit the position and they won't be able to sign new ones. The other thing, of course, to me that is key here is that von der Leyen says there could be more sanctions to come. Now, in terms of the debate today from European officials, it is clear that there was no consensus for oil. At the start of the day, there had been perhaps conversations that oil could be included here. It is clear now, based on this announcement, that today was not the day, but nonetheless, I hear this conversation is ongoing and some countries will continue to push so that we do see also bans on Russian oil going into the European Union.
AMH is the first step. It's a small one into the energy arena. Coal. Do they go a step further to gas, to crude? Where's the US on this situation at the moment?
Well, there are some European countries, Jonathan, that are already there. Take Lithuania, very tiny, but they went that step further unilaterally, not altogether as the European Union. The United States already cut off Russian imports, but of oil, gas, and petrochemical products from Russia. But the issue is that the United States has that luxury of doing that. They are not reliant on Russia the same way Europe is, and Europe just isn't there yet, isn't ready. But we should know, and I think Javier Blas, Bloomberg opinion writer, of course, he was the former chief correspondent for energy for Bloomberg News, put it really well on Twitter. He says this breaks the energy taboo. If today is coal, what are we looking at a month down the line? Potentially, you're going to have more countries unilaterally, like Lithuania, coming out and saying we will no longer accept Russian oil and gas.
Anne-Marie, down in D.C., thank you. Maria Tadeo in Brussels. Breaking the energy taboo. Kate Moore, can you weigh in on this? Where we are with energy equities, production in, say, Russia, what it means for the European situation, and how you're playing this story. And I know that's an unfortunate phrasing of mine, so forgive me for that. But I'm just thinking about how you might be pulling back from energy, given the rally we've already seen.
Yeah, we're actually not pulling back from energy at this point. Over the last 3 years, we have been mostly underweight and had pretty low allocations to the sector. But of course, over the last 6 to 8 months, we had been increasing our exposure, and we're at the highest weight we've had in the last 3 years. We're not looking to reduce despite the phenomenal run, because what initially inspired us to add to energy equities had been the supply-demand balance and how much sort of traditional resource was going to be needed in order to make it through the energy transition. That story is still intact. And of course, we have additional fuel on the fire from this conflict in the Ukraine. So we don't see the energy story getting better in the near term. Of course, we would change our view if we heard from a lot of energy companies they were going to start pumping a tremendous amount. But that's not the story we're hearing at all. The capital discipline is very much in play across most of the major energy equities. The second part of your question, though, John, was how are we investing and how are we playing here, in addition to the energy companies explicitly? We're also looking at commodities that are energy intensive, like aluminum, for example. That has been a core overweight in the thematic portfolio for the better part of 5 months. Some of that was weather related going into the winter, but now with reduced energy, higher energy prices and reduced energy from Russia, I think this is going to be an enduring story. So we're looking not just at energy equities, but other resources that benefit from higher prices and reduced capacity coming out of Russia.
Dan Skelly, can I throw that question at you as well, just in terms of the run we've seen in energy equities and where you and the team are at the moment on that story?
Sure, John. We've had a positive bias towards the sector for some time and continue to. Look, hopefully we're moving more towards some type of ceasefire or broader negotiation in Ukraine. And so you may not see that same parabolic move up that we've seen in the last several weeks, but there's still reasons to be long the space here. So number one, historically, as we start to dust off our late cycle playbook, it's been a space that's worked well within the latter phases of the late cycle, number one. Number two, when I think about Kate's point, look, we had dramatic capital pullback from the U.S. domestic sphere in the years leading up into COVID, and certainly the Russia-Ukraine supply issues have only made that more exacerbated. And then thirdly, look, in a world where volatility is going to remain elevated and where total returns at the index level are going to remain more muted, certainly versus the last 3 years, you're clipping a pretty positive dividend yield. I would just highlight it's the highest yielding sector in the S&P, yielding over 3%.
Greg Peters, just a final word from you on the credit side of things. Of course, the energy picture has been very supportive of what's happened in high yield over the last several months, given the sector tilt, the mix in high yield. Have you changed your views on that in the last month or so?
No, Jonathan. We're actually very constructive. We remain constructive both on crude and nat gas. So I think that story continues. Just the worry ultimately is that the high price effect and what that means for the economy writ large, right, and for the energy sector. And so, you know, the old adage of, you know, the cure for high prices is something to watch out for. But at this point, we're still quite constructive on the sector.
Greg Peters, Dan Skelly, Kate Moore staying with us into the opening bound. More still to come on Twitter. Your morning calls, and later, Elon Musk goes onto the Twitter board, fueling another rally ahead of the opening bound. That stock is up over the last couple of days by more than 27%. From New York City this morning, good morning. This is Bloomberg. 5 minutes away from the opening bell. Equities just a little bit softer, down 0.25% on the S&P, on the Nasdaq down 0.33%. The equity story not doing much, but in the bond market we are doing something. The yield curve through much of this morning a bit steeper. Your 10-year up 6 basis points, your 2-year up only 3, and right now at least just about the 2-year trading just about above a 10-year yield, but there's nothing in it. We're basically back to zero. That's the bond market picture. The story for Twitter, there is nothing passive about the stake of Elon Musk. He's getting a seat on the board. That stock is up again by almost 9%, up 8.9% in the pre-market going into the opening bout. That's the price action this morning. Let's get you some morning calls. First up with Goldman Sachs, downgrading First Solar to underperform, highlighting mounting headwinds, including rising prices. That stock is down by 3.64% to $80.90. Next up, Wedbush downgrading Starbucks to neutral, $91 price target, seeing a lack of catalyst for the foreseeable future. That stock is down to $86.53 and negative 1.77%, now 1.63. going into the opening bout. Your third and final call is MKM Partners downgrading Twitter to neutral, $49 price target, pointing to a fairly balanced risk reward following Monday's 27% rally. Well, here's another pop, up by 8.73%, close to 9 percentage points higher going into the opening bout at 54.40. Up next, Twitter running for a second day, naming Elon Musk to its board of directors. That is up next. On the year now, year to date, the S&P down about 3.9% on the S&P 500. This morning on the session, we come back a little bit, down 0.25% on the S&P. On the Nasdaq right now, down 59, negative 0.4%. The opening bout in New York City about to ring. There it is. Switch up the board and get to the bond market. Yields are higher on a 10-year, much higher in fact, by 5 basis points. We're back away from session highs though. Your 10-year, 245, 244. 49 to be precise. In the FX market, the euro weaker by 0.1%. Euro dollar sub 110, 109.60. Interesting moves in the Aussie. The RBA getting very close to a rate hike, it seems, dropping the word patient. Nothing patient about this Federal Reserve. They're ready to go 50 basis points, seemingly. Mike McKee coming up with Esther George of the Kansas City Fed in about 30 minutes, live on TV and radio. Looking forward to that one. Crude is up 0.7%, just short of 104. There we go, a 104 handle on WTI. About 30 seconds into the session, energy stocks advanced by 0.4%. The S&P down about 0.2%. Financials on the back foot, negative 0.4%. Early days with your movers. Here's Abby.
John, well, taking a look at all stocks other than Twitter, saving that for you and Ed Ludlow. Let's start out with the shares of Peabody, the coal company. It is popping higher as coal pops to a 13-year high, above $100 a ton for the first time since 2008. This, of course, on the possible European ban of Russian coal. The EU proposing a ban on Russian coal imports, again, helping out Peabody and other coal companies. Mosaic, the fertilizer company, up 1.5%. This, of course, on another potential ban. The EU will place a cap on the import of potash. This is a material used in fertilizers and is widely purchased from Belarus. Other fertilizer companies, not surprisingly, are also bouncing higher. Carnival up 5.6%, rallying as the company is saying it had its best week ever, busiest week ever, even pre-COVID. That clearly signals some end to the pandemic, at least right now. And Moderna, not surprisingly, down 3.2%. This as both the African Europe Union and COVAX have declined the ability to buy more Moderna vaccines, again, on the idea that the pandemic is coming to an end, at least right now, John.
Abby, thank you. You teed it up for us. Let's take a look. Twitter in early trading is up by more than 8%, up 8.63%. This as Elon Musk is named to the board of directors. Another day of gains. The former CEO, Jack Dorsey, tweeting his approval, saying the following: "I'm really happy Elon is joining the Twitter board. He cares deeply about our world and Twitter's role in it." Bloomberg's Ed Ludlow joins us now from San Francisco for more. Morning, Ed.
Good morning, John. Up 8.6%. That two-day jump of more than 35%. It's the biggest two-day jump on record for Twitter. Shares trading at their highest level since November. What a turnaround story for a company that sort of languished at the bottom of the pile of social media stocks, apart from Meta, the parent company of Facebook. The terms are very clear. Elon Musk joins the board as a Class 2 director. He can only hold up to 14.9% in terms of a stake during his term as director and 90 days thereafter. And there was some interesting stipulation in the letter from Twitter CEO Parag Agrawal to Elon Musk, dated April 4th. So you imagine last night that he can't go above that 14.9% using swaps or derivatives. Interesting, because Elon Musk stepped down from the board of Endeavor in March, which is effective as of June, March 17th, effective as of June. Interesting timing, John. So now we ask the question, what happens? You know, Elon Musk replied to Agrawal's tweet saying he's looking forward to working with him to effecting meaningful change on the Twitter platform. Parag Agrawal, the CEO of Twitter, saying that Elon Musk is exactly what the company needs, which is interesting. What does the company need, John? Because if you look at the share price versus the average analyst 12-month price target, we've got some catching up to do, and you do wonder how many consecutive days to come street analysts will look at their price targets and think, how do we model this? How do you model the Elon Musk effect? You see the white line is the share price surging above the 12-month average price target. Interesting one, isn't it?
Ed, can we talk about freedom of speech? I think the media and the user base obsessed with things like the edit button. We can come to that at another point. But freedom of speech is a big issue for Elon Musk, and I wonder how he's looking to reshape this organisation.
Right, so let's go back to the facts. March 25th, he tweets that poll asking his users if the Twitter platform upholds the principle of free speech. The overwhelming majority of respondents said no. We found out on Monday from the SEC filing that he already held the stake, 9.2%, by that point. Then you go back to November, December of 2021, when Jack Dorsey stepped down as Twitter CEO. Parag Agrawal was appointed, and Elon Musk tweeted a meme which depicted Agrawal as Joseph Stalin pushing his then former head of security into a river. And at the time, many took that to mean not only that Elon Musk had a problem with Agrawal, but that he had an ideological difference with him around content moderation on the platform. Well, Agrawal was moved pretty quickly, and if you listen to Cathie Wood yesterday, all of these street analysts we had on the show, they at least said even if he didn't become an activist investor, he was sending a shot across the bow of Agrawal, who's acted within 24 hours. It's been astonishing, John.
Ed, when you speak to people connected with this company, I wonder how hostile this might be. Dan Ives of Wedbush said this morning. Musk joining the Twitter board is a key signal that Twitter is embracing Musk rather than a more hostile situation. You've been going over the work from Dan Ives of Wedbush, not just today, but yesterday too. Do you think this remains the way it is, less hostile, or do you think it's bound to become more hostile, given we know he has a radically different view on what he thinks should be done here?
Yeah, I would note that a lot of analysts were very careful with the language they used, right, John? There's a difference between the word change and the word control. whether you're trying to affect change in a company or affect control or change to the company's operations are two different things. And, you know, Elon Musk has Elon Musk factor. He has more than 80 million followers on Twitter. He's arguably the most prominent person on the platform right now. And he leads a vast following who hang on his every word. We know that from the behavior of retail investors for Tesla stock who will act based on what he says on the platform. So, you know, most of the street analysts seem to look at this and say, is he trying to make a real activist play like Elliott did to affect management change? We don't know what his rationale is. We don't know his psychology. But he may just be trying to influence the platform because it's one that he's so prominent on.
Ed, thank you. Stay close. No doubt we'll have more news on this in the days, hours, weeks, minutes, who knows, still to come. Ed Ludlow on the West Coast, Twitter up by a little more than 7%. Deutsche Bank and Matt Lazzetti. Here's one for you. Matt Lazzetti just shot me an email moments ago. Here's the quote from him. I'll read it out for you. We see the Fed's tightening beginning to materially slow growth in the second half of 2023. He goes on to say, our baseline forecast has negative quarters for growth in Q4 23 and Q1 24, consistent with a recession during that time. That right there from Deutsche Bank is a recession call. Kate Moore, recession calls are very hard to call and very difficult to know what to do with. I mean, if I can guarantee you that outcome at the end of 23, the start of 24, can you do anything with that, Kate?
Well, I mean, I think it really depends on your time horizon, John. I mean, if we potentially have a decline in growth by the end of 2023, and let's just say that is like 7 quarters away at this point, I don't want to be out of risk assets in the near term. And by the way, you know, there are some companies, and I would say particularly technology companies and technology-enabled companies that have strong secular growth tailwinds, or actually we're going to see more spend, you know, directed their ways. Companies that offer platforms and services that allow companies to become more efficient, reduce their labor dependency. And regardless of what GDP prints, these companies are going to be incredibly important for most industries. So I don't want to lean out of the equity market in the near term with this prospect of slower growth or perhaps negative growth by the end of next year. And in the near term, I also want to really take a look at the technology companies that have been derated since November, but who have very strong prospects over the medium term. So, you know, I heard Dan say earlier that, you know, he was a little bit more cautious on overall equity risk. I think equities are still the best returning asset class over the course of 2022, even if we've had to take down our return assumptions meaningfully since 3 or 4 months ago.
Dan, your name was mentioned. I'll give it a chance to respond.
Yeah, a couple of comments. So first, I think the jobs market and the revisions we saw over the last week or so, you know, typically the jobs market gives you a lead time of at least 4 quarters in advance. So we are certainly not seeing recession risk this year. Look, if the Fed goes ahead with all this tightening and we have more inflationary pressures as a function of Ukraine, is that going to result in a slowdown? Certainly in 2023, we think so, right? Maybe not a recession, but a more material slowdown. And against that backdrop, I would concur with some of Kate's thematic convictions. In our equity models, we've been buying some of the digital transformation plays in the last several months. We've been buying names like Rockwell Automation, Accenture, which is a play on digital transformation in every industry, SBAC, which is a tower play, connectivity and 5G. So look, either the Fed goes ahead with all the Fed tightening and it leads to more slowdown, which augurs for having some growth names in the portfolio, which get a bid in a lower growth environment, or the Fed front loads it in the next several months and then pulls back a bit. And in that scenario, you actually like some of the growth names as well, because that would imply a cap on where rates go.
Dan, what is it about the construction of the S&P 500 at the index level that you really don't like? I get that you've got picks elsewhere, but what is it about the index that you just don't like?
On this interest rate level at 2.5 on a 10-year, at 250 on equity risk premium, we're seeing very rich valuations. We're in the top decile of valuations at 19.5 times forward of the last, call it 30 or 40 years. So we are rich, certainly. The dominant part of the market is that mega cap FANG, internet technology world, which has been kind of the tech theme of 2000 to 2016. As I just mentioned, we like certain tech themes, but we just wouldn't be in the mega cap space. We'd be a little bit further down the cap curve. The reality is once you get that big, as we all know, you are certainly more in the crosshairs of governments globally, Okay, and so not only do you have law of large numbers as a headwind, you have some regulatory headwinds as well on the horizon.
Greg, I wanted to give you the chance to respond to that Deutsche Bank piece. And for those just tuning in, I go over the quote from Matt Lazzetti and the economics team at Deutsche Bank again. We see the Fed's tightening beginning to materially slow growth in the second half of 23. Their baseline forecast is now for 2 negative quarters of growth, Q4 23, Q1 24, consistent with the recession during that time. Now, Greg, I'll repeat the question I asked of Kate. How useful is a call like that? If I can guarantee you that, how would you position for it at the moment today?
Guaranteed, Jonathan, huh? I mean, it's not so binary, right? So it's about risk reward and scaling back. And so just because you have that as a kind of a terminal concern doesn't mean you need to adjust, on or off today. But I do think kind of what's based in the market and what's in the price does mean that you should be scaling back because the risk factor is higher. And so, as you mentioned, it's really hard to forecast a recession, incredibly difficult. Only inflation is more difficult in my mind. So the risk is out there, and I think you have to start de-risking your portfolio in advance. Whether that recession comes about in the second half of next year or not, risk reward is still against you.
When are you a buyer of the long bond, Greg? Are we there already?
We're getting close. I mean, the war in the Ukraine has really changed the inflation dynamic. So we were, looking for the same kind of mechanical, issues that were described before. That, I think, is really pushed out. So I think it's too soon, but you are creating value. And so we're thinking of it as a sequencing. So the risk side, that door is closing, and the duration side, that door is opening. And it's just a matter of not getting trapped in between both doors.
And just to be clear, I can't guarantee anyone anything. Greg Peters, Kate Moore, Dan Skelly, to the three of you, thank you guys, really appreciate it. Coming up on the programme, the EU proposing a ban on Russian coal.
We must step up pressure against Russia, and we must step up our support for Ukraine.
That conversation up next.
The European Commission is already preparing the next sanctions package, and I hope that member states will be able to decide on ambitious next steps as regarding the sanctions. So we must step up pressure against Russia, and we must step up our support for Ukraine.
The EU proposing a ban on Russian coal and exploring the idea of doing something more, perhaps on gas and on crude as well. The United States preventing Russia from paying debt through US banks, turning up the pressure and forcing Moscow to find another way around. Damien Sasser of Bloomberg Intelligence joins us now for more. Damien, talk to me about what's been happening, how they've been able to pay some of their debt obligations and what's about to happen perhaps in the coming days and weeks.
Well, it hasn't been easy. I mean, they just had a $2 billion principal payment that was due on the 4th of April. What they were able to do was convince 75% of their creditors to take rubles instead of dollars for that debt. But the remaining 25%, $500 million to be exact, Jonathan, that's still held up with JP Morgan, so they have yet to make payment on that. And today's news that, U.S. banks won't be processing for the Russian sovereign is going to make things that much more challenging. So forget about that May 25th deadline for, receiving coupon payments. At this point, it's a matter of, can Russia actually make payments to its creditors logistically? And so that's where the focus is today. And really what this does is puts the onus on Russian reserves. We know that Russian reserves peaked in February at $640 billion. It's now down to $600 billion as of the 25th of March. Of that, $300 billion is frozen, Jonathan. That leaves, what, $200 billion. 130 of that is gold. Another 65 billion is China. Go figure. You know where they're going for their liquidity.
Damien, you used the phrase there. You said logistically, and that's the conversation that you and I have been having for weeks now. It's not been about ability or willingness, for that matter. Can they get the money from point A to point B, even if they've got the money and they want to send it? Can we talk a little bit about ability? What do we know about their ability to pay their debts, given what's about to happen to their economy?
Well, it seems that they have enough funds, certainly to get to the May 25th D-date that the U.S. government's kind of placed on, creditors to take in money. But it's going to happen a lot sooner than that. In fact, the Credit Derivatives Determinations Committee has to make a ruling on whether Russian railways actually defaulted, whether or not that was a credit event. They missed their 10-day grace period. They had money that was due on the 25th. So that could set off a whole range of different things, Jonathan. Remember, there's a lot of credit default swaps out there tied to Russian corporates, to the Russian sovereign itself, 41 billion to be exact. So, yeah, there's money that needs to change hands. And once that process starts, forget about it. All bets go out the door.
Demir Sessa, thank you, sir. As always, on the latest with the Russian debt situation. Here we are on sanctions with the EU proposing a ban on Russian coal. How that will work in the future we can talk about in a moment, but also exploring additional sanctions, including on oil imports as well. That from Ursula von der Leyen of the European Commission this morning. Bloomberg's Will Kennedy joins us now for more. Will, talk to me about this. What's been done on the coal front and what could happen in the future on oil? And put it all together for us too. How important this step has been for the Europeans today to go into the energy area on sanctions?
That's exactly right. In a sense, Rubicon looks like it's about to be crossed because until now, energy had been off the sanctions table. We know that there are a lot of EU members, led by Germany, who are very wary about sanctions on energy because they think it will have such a detrimental effect on their economies. But pressure is built, and now it looks like it's about to happen. They're going to start with coal, and coal, although it doesn't have quite the same prominence as oil and gas in the conversation, it's significant. I mean, Russia is the biggest supplier of coal to the EU. The EU is by far the biggest. It buys about half of Russia's coal, so it will make a difference, and it will have big costs for the EU. As you know, John, the coal market globally is already very tight. We saw record prices even before the war. And while there are other suppliers, South Africa, Indonesia, South America, they don't have much coal to spare. So it will add to the energy crunch in Europe. And it shows a willingness to go to energy. Now, oil is, of course, the big one. It's now part of the conversation. I don't think it's for this sanctions round necessarily, but the fact that it's on the table, I think, is also very significant.
Will, could you help us understand the numbers, the level of dependence that the Europeans have on Russian crude and how much Russian oil has actually come offline over the last few months?
So it's one of the biggest suppliers of crude oil into Europe, and not just crude oil. I think it's very important for people to understand that it supplies a huge amount of refined products, principally diesel. I mean, countries like the UK were getting a third of their diesel from Russia before the war, and that's a pinch point. But for Germany, it has real impact because Germany is at the end of the Druzhba pipeline, which is an oil pipeline bringing more than 1 million barrels a day of oil into Europe. The concern for Germany is if they don't have that oil, Berlin will find it very hard to get any fuel at all. The refinery there won't be able to produce gasoline or diesel, and they need time to work on logistical alternatives. I think the Germans will say, even if this is the direction of travel they want to get to, they cannot do it overnight. The logistical challenges are very great. It would cause far too much disruption to the German economy. Now, you can argue about what the price worth paying to achieve this is, but that's the German perspective, and I think they have a particular vulnerability when it comes to oil because of their use of pipeline oil from Russia.
The response that I've heard, Will, is that they've had 8 years. They had since 2014 over Crimea, and they just didn't set the ball in motion. Well, thank you, as always, Will Kennedy. That's the situation right now. We've got to confront that, not the history, I guess, and go over things in hindsight. Crude up more than 1% on Brent to 108.62 on WTI. Similar move, 104.33 with a sector price action. Here's Abby.
John, it's pretty interesting. And sticking with the coal story, the top sector on the day, utilities up more than 1%, up 1.3%. Making it interesting, of course, is the fact that yields are higher. So this dividend-rich sector should be down, but it has everything to do with coal soaring. Not far behind utilities, energy up 1.2% with oil. Yesterday's top sectors, the worst sectors, communication services, discretionary, and tech. Of course, all those mega cap sectors down just a little bit today, notwithstanding Twitter, of course, soaring. Down for a 5th day in a row, though, is the transports index, the worst 5 days, I believe, going back to 2021. And this, of course, John, as there are reports, one in particular out by FreightWaves, saying that there's a recession of some sort upon on the market load of trucks. So seeing some weakness there, John.
Put it together with the home builders through much of this year. Some big weakness there. The home builders down 28% on the S&P. Abby, thank you. Coming up, your trading diary, the events you need to look for, and why the Federal Reserve minutes are worth reading, perhaps this time around. From New York, this is Bloomberg. 25 minutes into the session, equities on the S&P unchanged. The sector composition of the move, the breakdown though, information technology struggling. The Nasdaq down about 0.7%. One single name, Twitter, is not struggling. That move right there up by more than 5% as Elon Musk gets a seat on the board of directors. Guy Johnson will pick up and run with that story in about 5 minutes' time. Your trading diary looks like this. President Zelensky addressing the UN Security Council at the top of the hour. Fed speak throughout the day. Brainerd Daly Williams all on the docket. Esther George coming up with Mike McKee. Don't miss that. Don't miss the president discussing healthcare at 1:30 this afternoon. Fed minutes come up tomorrow. Chairman Powell said look for that for details of balance sheet reduction. We will do just that. Oil executives on Capitol Hill coming up as well. And finally, rounding out Thursday with some jobless claims on Thursday morning. From New York, this is Bloomberg.